Good morning, everybody. Andy Tuttle here with the Tuttle Group at Fairway. Hope you're doing well, and hope I get this to you today. We're having some internet problems here, so we hope we can load this and get this to you. If not, you will get it Sunday at the latest. So we had a lot going on this week. Remember, this is the weekly market update. We do it every single week just to make sure you're empowered. You know what's going on out in the market versus all of the hype and media radio commercials and mis and disinformation out there. We want to give you the real information based on the market, what's actually happening, and what you can expect with the rates and what that's going to look like when you do get a contract on a home. There's a lot of volatility right now, and we want to make sure that if the rates are improving, that you know you can get more aggressive on the offer. If they're maybe getting a little bit higher and you're at the top end of the range, it could help you make sure that you're not overbidding for something, having buyer's remorse, and getting out later before it closes. So this is meant to empower and educate you. And of course, if you have questions, we want you to reply to the email here, go on our website, give us a call. We want to take care of you and make sure you answer those questions. If you're checking us out on the blog, of course, and you're not getting this kind of information for the lender, we want to be that lender for you. And we want to make sure to give you the kind of advice that's going to help you win the offer and, more importantly, feel confident and comfortable with the purchase options that you get. Okay, so let's go to the charts here. Remember, this is a price chart. This is November 8th. So the price chart means that the lower the price, the higher the rate. This is the election. Since then, we saw the prices fall over 400 basis points. Rates increase a full percentage point from their lows. Then we saw a rally throughout most of December into January. But now, over the last couple of weeks, we've seen another price drop. A lot of that has to do with the Dow, right? You've seen the rally. We finally hit over 20,000. Now, good news, since then, the Dow's kind of stalled out, kind of treading water, and it's let bonds get a little bit of relief, but we do need to watch this little line I drew here. That is a downward escalator that typically puts more pressure on prices to go into this range here, maybe even down to here, which would be another 0.25% higher than rates are today. But we have got a big news week next week, and let's talk about that. There's a lot going to happen coming up right now. So we have the jobs report coming out this week, which is very important. It will dictate a lot of what the Fed does, and how the market receives that will dictate if prices get worse or better. We've got the Fed kind of mixed in next week. They're coming out with some things. We've got the PCE, personal consumption expenditure. That's important because the Fed really uses that to gauge inflation. And in inflation, if they feel inflation is getting higher and too out of control, it's typically bad for bonds. If they feel it's a little too tame, that's typically good for bonds. So we have some housing data coming out as well, and all of that means that there's going to be a lot of volatility. But the good news is, if you want a silver lining, that if there's any kind of a bullish sentiment here for the bond market, with the stocks, Dow trading over 20,000 now, due for a little bit of a retraction, a little bit of a retracement there, it does give the bond market some room to see a rally. And if we do get that, you could see an 1/8 or 1/4% improvement in rate just next week. However, overall, we are going into the direction of higher rates. So something I want to put out there for you, if you're interested in this, if this isn't your home that you're going to retire in, if this isn't the long 10 to 15 year play that you want it to be, and you're very self-aware and understand that 3 to 5 years or 5 to 7 years is probably the length of time you're going to be in this house, talk to us about ARM loans. This is a great opportunity to get something that's fixed for 5, 7, or 10 years. These aren't those exotic mortgages back from the subprime days with prepayment penalties and points and all that stupidity. These are really good loans that you have to have excellent credit to even get. I do ARM loans because I know how I move, and I know how my wife and I are, and we leverage that option to get rates that are typically 1/2 to 3/4% below the 30-year fixed rate. So it's a great way for you to say, hey, look, I can afford the 30-year fix, but I really would like the extra cash flow to pay off debt, to have a little bit of extra reserves, a little extra cushion in what I'm doing. It's a great thing to look at. So if you're interested in that, let us know. Otherwise, no, get ready for a ride this week. There could be a lot happening. If you're out there making offers now and you've got questions on anything, please email us, call us. We're here for you. We want to help you make sure you get those offers. We know you're working with great realtors. We want to be the great lender to help secure up that financing for you and get you into this home at the right term. So have a great weekend. Happy hunting, and we'll talk to you soon.